Ladies and gentlemen, good morning. It's a real privilege to join you here remotely during the well-known Abu Dhabi Finance Week. Let me begin by highlighting that the financial system is evolving rapidly, shaped by, of course, innovation, new sources of capital, and shifting patterns of intermediation. Non-bank financial intermediation, or in other words, market-based financing, has become, as you know, ladies and gentlemen, a critical pillar of global finance and a key component of economic growth. And this evolution brings, of course, opportunities for diversification and for enabling economic dynamism. But it also brings new challenges for regulators. How do we maintain market integrity, investor protection, financial stability while allowing innovation to flourish? And this is exactly the key question that the International Organization of Securities Commission, IOSCO, its members, and other global bodies will need to tackle. Let me therefore start with some context. As you know, private finance has grown to play a vital role in the global economy. It offers long-term financing solutions, supports entrepreneurial activity, and provides investors with diversification and yield opportunities. And private credit in particular has emerged as one of the fastest growing segments of the financial system. Today, the market is estimated at around $2 trillion, having expanded impressively over the past decade. Private credit funds have stepped in where banks have pulled back, financing sector critical to economic resilience and growth. And this growth is of course welcome, but it also raises important questions. And as private credit becomes more interconnected with the wider financial system, its systemic relevance increases. And that's why global regulators, including IOSCO, are paying close attention. So what's the IOSCO perspective and work about this? I think it's not exaggerated to stress that IOSCO has been proactive in this space. In September 2023, we published a report on emerging risk in private finance, which highlighted key vulnerabilities, hidden leverage, and liquidity mismatches, particularly in funds offering redemption options despite holding illiquid assets, opacity in valuation and structure, making risk assessment challenging, retailization trends as retail investors gain exposure to complex products, interconnectedness with banks and insurers creating potential transmission channels in times and stress, and the need for effective data for risk monitoring. All of these remain highly relevant today, and IOSCO has since deepened its work in this area by working closely with the FSB, the Financial Stability Board, that's advancing initiative on NBFI data and recently completed its recommendation on NBFI leverage. On NBFI leverage, crucially, the recommendation addressed the need for authorities to establish domestic frameworks to effectively identify and monitor this leverage risk. They also explicitly target counterparty credit risk management, that's the so-called recommendation number 7, urging authorities to review the adequacy of existing private disclosure practices between leveraged non-banks and their bank leverage provider, and this will be an important but a very delicate thing to balance. With respect to valuation, allow me to say that IOSCO just recently published its consultation report on valuing collective investment schemes, which seeks to tackle some of the challenges presented by the inherent heterogeneity in private market valuation methodologies. There was a strong case for updating existing IOSCO principle, since the market has evolved with an increase in collective investment fund holding less liquid and illiquid assets, including private assets, as well as increased retail investment in such themes. Further, as the market pushes toward retailization, a key area of supervisory focus will, of course, be the alignment between a fund's obligation and the liquidity of its assets and whether retail investors understand the risk of their investment. And this is an area IOSCO will continue to look at in 2026. How to look ahead? Because we know that there is still a lot more to do. Well, understanding the interconnectedness in this market will also be fundamental. And the key nexus that connects the private market to the regulated system are the large bank brokers dealers. These banks are not made bystanders. They are the central providers of financing and liquidity to private funds. Furthermore, these banks are key information holders. They possess vital data on funding utilization, drawn down patterns, and borrowers' overlaps that we as regulators could better utilize to complete the picture of system risk. The sophisticated links between large banks and private funds means that shock originating in the private segment could rapidly reverberate across the traditional banking system. And finally, of course, I want to touch on data. Over the course of our work, it has also become increasingly obvious that robust data is essential for effective oversight. The evolving significance of private market necessitates a corresponding evolution of regulators' understanding of the risk in this market. And we need to move beyond reliance on aggregate statistics, which by their nature can obscure the structural risk and concentration that define these markets. We indeed need detailed data to understand where the main risks come from and how different players are connected. Specifically, we need to answer two questions. First, where exactly is the leverage and how big is it? This includes leverage inside a fund at the level of the company it owns or through special financing tools. Second question, how are exposures spread across sectors and countries, and how do they flow from one to another? This is also key to understanding how problems in private market might spill over into the regulated banking system or other parts of the world. And without this level of detail, we can't fully understand the real network of exposure. And our challenge is therefore to strike the right balance, ensuring we have the tools and information to safeguard stability while preserving the flexibility and innovation that private markets bring. It's about smart, proportionate oversight that support growth while simultaneously protecting investors and the financial system. And I encourage all to engage openly in this discussion. We have a lot to learn from each other, and the better we understand this market, better we are able to respond in the right way. Thank you for your attention.